A good morning, everybody. Happy Tuesday to you, June 3rd. We're in a new month, a new week. How have you all been? I know we talked about yesterday. I said, hey, let's talk about those GameStop deep in the money puts. We were seeing those again. Just said, hey, and to be honest with you, whether the posts get any likes, I'm still gonna post the video. I just do that for fun. So when I always say like, if this post gets just one like, I'll post a new video. Just know I'm gonna post it anyway. But I just do it for fun. So we talked about the $120 puts that came through yesterday for GameStop. I know a lot of people were talking about them. About 22 million there in premium came through, and then we also saw the $125 puts. And we've been seeing those. We've talked about this. I've made quite a few videos going over it. Some people can use the deep in the money puts for as basically building a synthetic long position. It could be used by short sellers. Could be just arbitrage. It could be a couple different things, scenarios. And we've seen the last few days, here, a little bit of action there on the $125 puts for January. So yesterday's premium about 25 mil. Now we're going to take a look at all that option flow. We'll see of that volume, how much of that did carry over into new open interest. Because when you do look at the volume here of 2,681 contracts traded yesterday on that 125 put, each contract obviously represents 100 shares, so that's only 268,000 shares. Still not, it's not small, it's not large, but it's not too small, but it's not like, oh, holy cow, what jumps out to people is just the amount of premium. And like we talked about before, for example, if you take the strike here of 125 and you subtract the premium here, which was the 95.18 paid, let's do the math here. You can take your phone out or, take your calculator out, take 125 and minus 95.18. Just try to show you the math is 29.82, which is actually a little bit less than the current stock price. So if I was building, for example, a synthetic long position, I could, in theory, sell the 125 puts. Now, if I sell just one 125 put, I'm going to need at least 125 times $100, which is $12,500 in collateral to hold against selling that open put contract. So I would need at least 12.5 in my account to cover that, and then I would receive this 9,500 in premium. And then essentially, if I'm forced to buy shares at 125, is that 12.5? Well, if you take your 12,500, that essentially, if you got assigned to buy these shares at 125, you've already received $9,518 in premium, which is a difference of 2,982. Again, divide by 100 is your 2982. So it's a share. It would make your shares actually cheaper than the market price. So again, if you were a short seller, for example, and you shorted the stock, say you shorted GameStop last week at like $35, you could use this particular strategy as a short covering. Also, we saw with these, it seemed to be every time, when you saw some of the deep in the money puts, I'd noted somebody had replied, hey, I see, sometimes the price move a few days later, so we saw the 120 puts. We're also going to talk about the 125 puts we just talked about. Because the net call premium yesterday was very small with GameStop. It was only about 1.5 mil, but that net premium was the bulk of it right here. So we're going to take a look at where the bulk of the money was spent in the option flow, as GameStop did close above 30. So when you look at the actual daily chart here, that was a nice close, even higher than above your earnings gap up in March, sitting around that zero point 0.5 Fibonacci 30.73. And also right around the 9-day EMA, which is 30.41. You're welcome to take a look there in your top left corner for your daily moving averages. 21-day moving average at 29.33, which is sitting just below that 382 daily fib level. So we're using the recent low back in May of 25.66 and the high of 35.80 here on our just Fibonacci charts. So, if you're looking for any 382 bounce or 21 EMA, if, down here is support, if price were to continue to move down, as well as the 236, and then your previous 50-day level at 26.90, and your 200-day at 25.55, which GameStop has not tested. The 200-day, it hasn't touched it since April. And then we had the Golden Cross at the beginning of May, and GameStop's been pretty bullish since then. Did see that high of 35.80 back on May 28th. But let's look at that. Let's break down some of that option flow. We're going to take a look at where the bulk of that cash was wrapped up within the option flow yesterday. Let's pull that up here. Pull it up by top premium. We're going to pull up yesterday's date here. And you can see here it's the 125 and the 120 puts. So that was the top of the premium. So let's look at the 120s. It's the same scenario here. If you take this 120 up there as your actual strike price, for those that didn't know, a lot already know about how these options add up. But for those that don't know, if you take the $120 and say, for example, you subtract the current share price of 30.85 is 89.15, which is roughly the premium paid 90.03 for the contract. Conversely, you could take 120 minus the premium paid or received, in this case 90.03, is a difference of 29.97. Again, just like we talked about with the $125 put, this makes essentially getting shares cheaper than the current market price. So that would be, a reason why potentially you would do that. So, for example, yesterday we had the 70 mil in total premium. Not a bad day in that regard. And that made that net premium a positive 22 because they were selling. So these 120 puts, there was 2454 volume yesterday, which represents basically 245,000 shares. But you can see here, only the open interest only increased by 1225. Now, what we've noted here at the last times we saw the deep in the money puts like this, usually the next day only about half appears in new open interest. Market makers are not just going to give you free option premium. They're going to want something for it. So, for example, if I sold a bunch of these puts yesterday, let's pull them up. And mind you, like I said, you need at least 12 grand collateral to sell at least one of these cash secured puts. So whoever's selling this, mind you, has pretty decent pockets. So like I said, the collateral to sell a $120 put is either 12 grand cash, or you need to be a level 4 options trader where you can sell naked and have a margin account. So chances are it's probably not. It could be, another retail, could be a hedge, it could be a short. You never know who's doing it. But for example, like I said, if it's 12,000 cash secured, roughly to sell one of these, and there was volume of 2454, it's going to need somebody with about $30 million in cash as a collateral to sell this. So it's not going to be somebody that's broke. It's going to be somebody with money. Like I said, could be a short seller using it as arbitrage. It could be a synthetic long. I shared that on my X, and I've shared it many times. The video where we break down the math. Like, for example, when we broke down the math on the $95 puts, a lot of people responded well to that video. Same kind of concept that we're discussing today, just a different strike price. We're discussing the 120 and the 125. But I broke down the math. It's a really great post there. Maybe I'll just repost that. And then as well as I linked to Investopedia, which is really great resource for information and education. But just a little bit more information about deep in the money puts. For example, deep in the money option allows investors to profit the same or nearly the same from a stock's movement as the holders or short sellers of the actual stock, despite costing less to purchase. Like I said, we do these shares were coming out a little bit cheaper than would be just buying them at open market, and I wouldn't have to essentially disturb the open market there if I was a short seller. So, like I said, I've put that out. I'll probably relink that to this video as well because I think it helps. It adds to the understanding, whether it be the video or in the text format. So, like I said, so if you have this, the 120 minus the 90.03, that's your 29.97, cheaper than the current price. So, for example, you'd say, well, why would I do that? Well, if you want the stock cheaper, if you think, say, this is the bottom for the stock, that may be why. If you're a short seller, your strategy may be different. So that's why, the chain's been pretty quiet here on the 120. And then, boom, they just rolled up and sold 22 mil worth. And then about half of that appeared in new open interest. So what could have happened there? If I sold a bunch, the market maker assigned me shares at 120. And you'd say, well, why would I buy shares at $120 each? Ryan, that's 12 grand. Yes, you're right, it is. But see this premium you already received? That represents 9,000. So you've already received 9,000. So you're basically buying your shares at $30, still cheaper than the current market price. That is why you would do that. Plus, like I said, it's somebody with cash. Like I said, it's to hold that you need about $29 million in cash to sell that many cash secured puts. Unless you're a market maker who They can sell naked, and then like a level 4 option trader with margin can also sell naked. So same with the 125 puts. We've seen activity the last 3 days, the 29th, the 30th, and then yesterday. You can see the M's. Yes, you can see some being sold. And then each day, about half carries over into new open interest. So if you look here, let's zoom this out, the 125s. The last time we saw some of that activity was back on the 15th and the 19th of May. So let's go back to the 15th and the 19th of May. Let's look here at GameStop, 15th. Boom. A little bit of action there. A little bit of volume the day before. And then the 19th, flat. And then what happened here? A few days after those transactions, boom, stock moves up. So, similar concept, we saw the in the money puts back here. Boom, stock moved up a little bit. So, you never really know who's behind it. I'm just trying to tell you it's somebody with big pockets. So, as for, but that's for like I said, the deep in the money puts. I've explained it many times, made many videos, many posts about it. So I feel like I'm beating the dead horse at this point. So let's move on from that. And then we also saw yesterday. So I'm sorting here by top premium, which I always do. So here's the amount of premium, total premium. And then here's the actual, what was it? Was it a call, a put? What was the strike or expiry? And I generally look for about 500,000 or higher. Yesterday was actually pretty light for GameStop. The two big hitters were the deep in the money puts. The rest, we can take a look at it here. Was like $35 calls for this June 20th expiry. So for the monthly expiry, we did see some premium there. About 2 million yesterday in total option premium. And that came through, let's see, right towards the end of the afternoon. Now, about half of that appeared in new open interest. And yes, it does look bullish. Total premium, too. If we note here is some multi-legs. I'm pretty sure, I didn't see it in real time, but I think this trade was actually connected with others. It was a floor trade, and it was a multi-leg. You can see that denoted here on Unusual Whales as a multi-leg option order. That's what the ML-O under the legs column is. And we can take that a little bit further with the granularity of Unusual Whales. So what they did here, let's see, long multi-call. So 35s and 50s combined. Floor traded 39.75 each on the size. So it looks like the 35s and the 50s. Let's see some of that coming through bid and ask. So look at that. There might be two separate transactions here. So this would be like a long multi-call in that regard. So they're just long the stock. Let's double check those. Because I saw in addition to the 35 was also the 50. So we'll pull that up here. There was 30 for this week, and then the 50 I just said was also on there. And that had multi-leg as well. So 11,582 volume. About 9,300 new open interests. So if we look at these as well, let's make sure we're both sides of that. Let's take a look here at how that went down by premium. So we'll pull up that actual largest candle. We'll see they were paid 66 was the spot at the time. The bid was 66. The ask was 67. So it was assumed they paid closer to the ask and that it was bullish in that regard. Again, linked to the 35, so like a long multi-call. So potential strategy here used. So yeah, they're looking for up. They're looking for up on the stock. That's what that trader is betting on. Potentially there. And then let's look at these 30s. They came through also yesterday for this week expired. It's about $1 million premium, but like I've said before, when I say split between buyers and sellers, it's because it was split 49% bid, 50% ask. So it's like, while some were buying here and then selling for profit, some might have sold here to buy back later because of the bid volume here, 42.65, and the ask volume. So you got buyers and sellers. That's what I mean by that. So yes, about 11,000 volume, but only about 1,300 appeared in new open interest. So some traders were buying these $30 calls for this week, about $90 yesterday, mid-afternoon, and then they're up to about 140. So not a bad move there in that regard. Seeing some of the $30 calls for January as well. Because I saw the open interest decrease. Might have been selling some of those, just leaving that position. Because I noticed the last couple days we had some decreases in open interest, a little bit larger on the bid side. It's about 757 volume. Open interest decreased by 300. Could be somebody just taking some cash. If we look at historically, sometimes you can see could be selling the calls, could be buying them, could be taking profits. As you look historically, last 30 days, some buyers, some sellers. Again, the bid volume over the last 30 days, 13,000. Ask volume 11,000. So split, buyers and sellers, day traders, scalpers, etc. And then 30s also showed up for July, the July OPEX as well. So seeing a little bit of gamma as well into the June and July. And we've been talking about that here on the page and in the videos. About 500,000 in premium yesterday, and not a lot carried over new open interest. Like I said, the big hard hitters was comprised mainly of what you saw within the those deep in the money puts. So let's take a look at the biggest changes to open interest this morning for GameStop. Let's see the big increases there. As the 125 puts and 120, and then the 50s and 35s, which we just talked about, those calls as part of that long multi-call transaction. 32 and 32 and a half for this week, and 33s and 35 saw a little bit of increase in open interest. 32 and a half, so let's see a time of filming. Just out of the money there as GameStop closed at 30. So let's see here yesterday. I know because I saw an alert for those on unusual wells because they got alerted for volume greater than open interest. So filling around 40 and then popped up to about 50. So about a 25% move on those little out of the monies with 95% volatility. So yeah, a little bit there, a little bit of action there. So that's what I had in regard to those deep in the money puts and what you saw. Let's pull up some of that gamma though, and we'll take a look at that and see how that profile still exists. Because as the chart did calm down a little bit there, gave that RSI a chance to reset, let some of that volume reset, and the stock still clocking around its 9-day EMA at 30.41. Nice close though. I think a close above 30 is always solid, especially when it comes to GameStop. So let's pull up some of that gamma here and take a look at that. And with that spot gamma, like I said, it's basically for every 1% change in stock price, market makers essentially need about $22 million to hedge that. And they're hedging to the long side for about 2.3 million in shares. So your largest open interest here at 30, but it's built out into 31, 32, 3, 4, and 5. And just like last year when I talked about the gamma at 23, 24, if that thing starts moving to 25, 26, there was a lot of open interest at 28, 29, 30, and you got a gamma squeeze where the thing squeezed to 30 and then went up to 35 just because there was open interest there. There was some FOMO, there was more call buying, and that gamma ramped up. And then as people, for example, last week sold some of those calls and took profits, you saw the gamma work in the opposite way, where if I sold a bunch of calls and I'm a market maker, I got to hedge all this with shares. But then as people begin taking profits or selling the calls or selling covered calls or taking their profits, I then begin selling the shares because I don't need the hedge anymore as I'm trying to get my book back to delta neutral. That creates some additional downside pressure. So gamma works two ways. It works really well upside, and conversely, it can work to the downside as well and create that downside pressure. So always keep that in mind when you're visualizing that gamma. It's not necessarily up, but it can be strong both up and down. For those that aren't familiar, go ahead and pause or screenshot here, and that way you can read a little bit more on your own time about spot gamma exposure. Because I repeat this in every video as just a way to highlight. Because I realize that some people are just new to the video, so this is the first time for you watching a video of mine, and for others, it sounds really very repetitive, and I do apologize. But like I said, just try to give the information. So we take a look at that actual gamma here, and we've noticed, like I said, strong at 30. You get some more net gamma building up here above 30, and you see that the thing moves up 31, 32, induces more call buying, more FOMO, more shares, and then more positive sentiment. Stock moves up, people sell calls, the rally fades a little, sentiment changes. Yeah, it's rinse and repeat. You've seen this since 2021. Hopefully everything, all the videos and all the flow we've been covering since last year before the stock squeezed last year. We were covering at 12 before it squeezed to 60. And we brought you all the flow at the end of April last year. Same kind of scenario where all of this played into it. The only difference between last year and this year is like Roaring Kitty was lurking last year, but this year's still plenty of seasoned traders know exactly what they're doing, building their own gamma ramps. So, but that strong gamma there, that gamma for this week expiry, and then built for the June expiry, which is June 20th, and then building out into July, just like we had talked about back in April and May, or pardon me, March and April. It was building out into May, and I said as we approach May into April, we'll start building out into June, which we've done. So when you look at that gamma in that regard, and I'll let you pause here if you want to get the gamma exposure. If you want to pause or screenshot there, that way you've got that for your data. Please go ahead and do that. That way you can get more familiar with gamma exposure. And if you're using unusual whales, this will lay all of this information out for you. In addition to that delta, strong call delta, net delta there at the 30. Like I said, we've already been in this position because the stock's at 30 in that regard. And then your highest delta by exposure, yes, this week, but built definitely for the June OPEX. Net delta pretty strong for June 20th. Post earnings as well. And then July 18th, because GameStop will have earnings coming up next week on the 10th. I'll be live at GameStop Thursday night at midnight. We're going to do the Nintendo Switch 2. I know I'm excited. Thursday, yes, that's just a couple of days. And then largest decks by strike and expiry right there at that 30. So pretty pivotal level. A nice strong close above 30, move 31, 32. You start seeing some of that gamma take effect. You start seeing more of those calls that are, lingering out there, the open interest out here at 31, 2, 3, 4, and 35. So all of these are in the money here. So, yeah, it could get a little dicey. You've seen this before. You know what happens. The options market as of right now, the time of this video, is about 40 minutes away from market open, and this changes all the time. But right now, the expected move is about 12% on GameStop next week. So that's plus or minus about $3.70. So $3.75 move coming on the stock based on the option market, up or down. Doesn't mean it'll happen. It's just what the expected move is based off earnings. So yeah, not a bad in that regard. Let's look at what GameStop actually is ahead of the market opening this morning. Trading at 30.85. Okay, so just above its 9 EMA. But there's your daily fib levels. Here's your EMAs over there on the left side if you want to take note of those. We got your flow laid out. We got your definitions. Make sure you go back to the post. Maybe read more about deep in the money puts, how they're used. You're welcome to use the information here on my X page, the internet, unusual whales. Like I said, I put a lot of information out there about this topic because there's a lot of misinformation about the topic as well. So that's what I got for you today. Happy Tuesday. Hopefully you did enjoy the video. If you watched it all the way through, you're a legend, and I value you, and I value your education. I value your time, and you value your education and time because you're investing it into learning, and that's exciting. I always appreciate sharing, and those that do tune in. So if you watch all the way through, why don't you just reply down below, deep in the money puts. I'll know you watched today's video all the way through. But everybody have a fabulous day. Trade your plan, manage your risk, and nobody else can do it for you. And if you're not comfortable enough with it, I suggest hiring a professional. Then you can put them on the line for it. But y'all have a fabulous day, and I'll see you lurking around the internet today and real soon. Have a great day, everybody.